This is InvestTalk, independent thinking, shared success.
Hello, my name is Sam. I would like to hear the opinion on Freshworks, FRSH, I think is the ticker symbol. I'm considering taking a small position in there. Thank you.
Freshworks Inc. is a cloud-based software as a service company, SaaS, headquartered in California, though it was founded in India, I believe. And what it does is it provides software to seek to improve employee and customer experiences. So we're talking about their Fresh Desk is one of them, Fresh Service, and Fresh Sales. Their Q1 earnings, pretty decent, 18 cents per share, surpassing what the estimate was from analysts, about 13 cents per share. But in spite of that, the year to date, they're down 10.27%, down 16.18% over the past 3 months. And over the past 2 years, well, year and a half, I would say, just about year and a half, because it's already almost the end of May, well, they've underperformed both the S&P 500 and their industry as a whole. Revenue growth has been good, but mostly back-end heavy, right, from 2019 into 2022. In the past couple of years, they have been growing, albeit not at that giant pace of 33.1% on an annualized basis. Now, in terms of margins, they are negative. It is a company that has not made money, at least in the past 6 years, though it is projected to have net income of around $170 million. And if Q1 earnings were any indication of how on track they are to turn positive, well, beating is certainly a good thing. Now, it's about a $4.3 billion market cap company with about $1 billion in debt as of the end of last year. Oh, I'm sorry, looking at the wrong number. Only about $40 million in debt. Big difference between $40 million and $1 billion. But if they're not doing debt, how are they funding this company that doesn't make any money? The answer, they're issuing a lot of shares. Up from 260 million shares in 2021 to about 300 million this year. Got a bit of short interest out there, 5.19%. So a lot of people in the market seem to think that the price is a little too high here. Trading about 24.5 times forward-looking earnings. Price to book value, 4.1. Price to cash flow, 24.9. A little bit on the expensive side. Generally, we don't like investing in companies that don't make money. Because in times of economic instability, in times of uncertainty, they tend to take a big hit. And that's what you've seen over the past 3 months, right? Down 16.18%. In spite of that earnings beat, the end of April, they did march back a little bit with the rest of the market, but still. Local high of about $16, fallen back down to about $14.50 as of today, down another 1.56% today. And so, I think that the tech industry, specifically, broadly, is a big winner and loser industry. And this growth is solid, but my worry here is how much it has tapered off in the past 2 years. Although there was a solid earnings beat as well, not enough to really break the downward trend that's been going on since the beginning of this year. Trying to find maybe some support above the local low. But for now, I think there are better opportunities out there than Freshworks. Small company, issues a lot of shares, hasn't made money yet, but maybe this year's the year. Thanks for the call. Let's keep things moving and get to another question. This one came in from our friend Randy Ramos on our YouTube channel. If you haven't checked that out by now, I think it's pretty cool. We split up our segments for you, make it nice and easy to digest. And this question's about Uber. It says, looking at Uber, what are your thoughts? Love the free cash flow. Could it be a good long-term hold? Well, Uber is certainly a darling of retail traders. It's up 38% on the past 52 weeks, up 47% year to date, up 12.4% in the past 3 months. I'm sure we all know what Uber is, the ride-hailing, food-delivering, freight transport company. You get it on your phone. You can just order it there. And it really was groundbreaking as a business. It started finally making money in 2023, and their margins have really been all over the place, right? 2023, they had 5.1% margin, then 22.4%. Last year, projected to be about 11.9% this year. But he is correct, Randy is. Their cash flow, phenomenal cash flow growth. Look at this free cash flow. That's a lot. Up from $390 million in the positive in 2022 to $8.8 billion. And sales, although growth has slowed down a bit, right? A lot of that growth was coming out of the pandemic. Still pretty solid. Over 10% growth, close to 20% or close to 20% growth here. pretty great. In terms of valuation, still kind of expensive, 24.2 times price to cash flow, 4.3 times sales, 29.3 times price to forward-looking earnings. And they do issue a bunch of shares, up from 1.8 billion to 2.1 billion this most recent quarter. Now, it's a $192 billion company, only about $11 billion in debt. And so my big concern here is, you have a little bit of a stretched valuation situation. From a relative strength perspective, they had a rough pandemic. Coming out of the pandemic, they were very strong. They finally started to make money. But story out of San Francisco that I saw is that Waymo is now doing more rides than Lyft in San Francisco. I believe I saw that. Don't quote me on it. As always, do your own research here. But so I think that one of the threats to this business model is autonomous driving. And so from a long lens perspective, that could be an issue. Now, Uber is enhancing its partnership in self-driving by partnering with Waymo to integrate their autonomous vehicles into their networks. But Waymo's not the only one. As this becomes more and more successful, you will have more and more tech giants trying to enter this space. And so from a long-term lens, I am a little bit weary of that, but it is hard to give up on this cash flow. Adds a substantial amount of cash flow, and it's cheaper than it's been in quite some time, but still not cheap enough for me. So for now, I would hang back from Uber. It's had a big run-up this year. It's had a very big run-up for a good reason. It may have found some resistance. It may start to look for support soon. Soon may be time to enter. Wouldn't say that is now. Thanks for the call. That is Uber Technologies, ticker UBER. And we might not have time to answer this one before the break, but we can certainly play it. So let's hit you with another question now.
Jeff calling from Iowa, and I'd like to know what you guys think about Dollar General right now. I know their earnings have been decreased over the last couple periods, and I was wondering if you could take a look at their historical earnings and maybe, let us know what a good entry point is for Dollar General right now. Has the market overreacted, or do you think it's going to drop even more? Thank you. I look forward to hearing your answer on the show. I appreciate everything you guys do.
Dollar General, ticker DG, I'll preview it for you right now, is one of the leading American chains of discount stores. It's been around for almost 100 years. They sell all sorts of products from food to cleaning supplies to home goods. Over the past 52 weeks, it's down about 29.33%, but it's really had quite the climb year to date, up 39.92%. So when we come back from the break, we will talk about this $22 billion company that has quite a bit of debt, and if we think now is a good time to enter. Before the break, we were taking a look at Dollar General, the discount retailer. Had a rough past year, but over the past 3 months, been pretty strong, up 31%. Its revenue growth, pretty solid, though it has slowed down in the past couple years. And margins, honestly, a decent chunk of change higher than what you see in a lot of retail names. But you cannot ignore the issues that it may face. The reason why its products are so cheap is because a lot of them are imported. And so should tariffs be higher than they have been in the past, well, this company's margins aren't that stellar, right? 4%. They have no choice but to raise costs. And so if they raise costs on consumers that tend to be on the lower end, whose incomes are already going to be hit by inflation, that could be declining revenue as well for them. And so with that being said, understand the risks. Even if I were to say, yes, Dollar General is the one to go with, they're reporting earnings on June 3rd. They had an okay earnings the last quarter, though they did revise downward their year-end projections. I think it's worthwhile to wait and see what they say at the beginning of June and see how the market adjusts accordingly. That is Dollar General, ticker DG.
Hi, guys. This is Kent in Texas again. I was calling for us old guys in their 70s that are getting long in the tooth. What I want to know is what y'all recommend us as far as our spouses, like mine of over 50 years, and as far as involving individual stocks and ETFs or mutual funds. Do y'all kind of tell us to get further into the ETFs and mutual funds and out of individual stocks when we're this far down the road and way closer to the end than we are the beginning? All right, my friends, that's the question. Thanks a lot. Bye-bye.
Well, that's a great question because hopefully for each and every one of you, this becomes an important topic, meaning that you have reached the point in your life where you were trying to preserve capital, where you're spending rather than saving. And so as you move into that time, I think two things happen here. You want to reduce your risk on the equity side, and that means investing in more value-oriented businesses, ETFs, which are generally, hopefully broadly diversified, ones that have low basis point expense ratios, but also move more towards fixed income. You should be thinking about preservation. Equities are, in the long run, for capital growth, but they can be far more volatile than bonds. We all know this. And so as you're approaching retirement, as you're approaching when you need to actually be spending rather than saving, you want to glide path that allocation more towards fixed income and further away from risky equities. Let's keep things moving and answer another question. This one on a stock, and it's on ticker UNH. UNH is United Healthcare. It's certainly been in the news recently. I think we recently answered a question on it as well. But you know what? We will answer another one. It says, hello, I bought some shares of UNH at $258 for a long-term investment. Is it a good idea to own this stock for a long-term investment? Well, taking a look at UNH, which is United Health Group, it's had a rough run over the past, about a year now. Actually, no, most of its poor performance has been in the past month or so, right? So year to date, it's down 40%. The past 52 weeks, it's down 42%. Past 3 months, it's down 35%. It owns and operates two primary businesses, their insurance benefits and Optum. And a lot of their revenue comes from their Medicare Advantage segment of their business. It is one of the worst performing stocks of this year. And the reason why is, there were some leadership changes, right? Their CEO stepped down amid the company's ongoing challenges. But more importantly, we learned after a recent rundown that they're being investigated, that is, for Medicare fraud. The allegation is that they made secret payments to nursing homes to reduce hospital transfers, which would compromise patient care. Now, if you bought it at $258, you did catch a local bottom unless you've held it for a long period of time, but I doubt you have. But I think that anyone who's invested in this name has to understand the risks. Should there be a conviction on Medicare fraud, this company would not be able to participate in one of its largest plans, Medicare Advantage. And that would drastically impact the financial performance of the company. But anytime there's stress like this, it is when you potentially can start to make a decent amount of money. For me, I think it's too risky here. I think you're banking on guessing what the outcome of a criminal investigation against the company will be. And I think at the end of the day, that's just guessing. That's buying the dip and hoping. And so for me, if you want to get health insurance exposure, it's probably better to do it with a company that doesn't face a risk of being shut out of a market that is one of the most important to its business. That is United Health Group, ticker UNH. Let's talk about flows, because oftentimes you can tell a lot about where investors think the market is going to be by where their money is going. And so far this year, between December and April, ex-US equity funds, meaning equity funds that invest maybe globally or in developed countries, but don't have the United States, saw $2.5 billion in inflows, reducing, that's net inflows. Reversing that is 3 years of net outflows. $2.1 billion of that came in February, March, and April. And anytime there is demand for something, fund managers will create products. And that's what you're seeing. You're seeing BlackRock create ex-US ETFs, more ex-US ETFs, DWS, Amundi, all launching new ETFs to meet this rising demand for investing outside of the United States. Why would they do that? Well, tariff fears, costs that as consumers have to pay tariffs in the US are borne only by US consumers, not elsewhere. Stoking the fear that the US market could disproportionately slow growth. The scale and nature of the policy, the math behind which it was created, was shocking. And so when that happened, you saw what maybe you can call a patriotic rebalancing in Europe and in Asia, where European investors are intentionally reducing US exposure for political reasons. You also had, going into this, some decently high concentration and valuation risk. The S&P 500 was very expensive. It was very concentrated. It had primarily been driven by one thing, the secular AI growth theme for 2 years. And so it could be the case the move is less about politics, is less about trade, though certainly that has a part in it. It could just be about diversification. The US as a share of global markets was at, I believe, a record high, something phenomenally high, close to, if not above 70%. So what this could mean is often what they say in a lot of things, which is follow the money. Perhaps this historical underperformance you saw when the US had, yes, inflation, but lower inflation that was tamed more quickly and higher growth than the rest of the world in 2022 through 2024, and therefore outperformed dramatically, maybe that's starting to reverse. Certainly the sentiment may be. Either way, the trend does show growing skepticism about US global financial dominance and what affects a wide array of portfolios in terms of flows certainly can affect equity returns globally. We love your voice bank questions, so let's play another one now.
Love the show. Appreciate getting to listen to it, and really appreciate you answering caller questions. This is Francis in San Francisco, and I have a question about ticker symbol FRS, is an ultra short real estate ETF. And I was curious about what you think regarding purchasing a small position. Would love your opinion. Thanks again for taking caller questions. I love the show.
Alrighty, so the ProShares Ultra Short Real Estate ETF, it's an exchange traded fund. What they're trying to do is they're trying to seek the daily investment results corresponding to 2x, so it's an inverse levered ETF of the daily performance of the S&P Real Estate Select Sector Index. So it takes the S&P 500, it finds companies within the S&P 500 that are real estate, and then it's going to mimic the return, the inverse of the return, times 2. And so we talked about this actually in our newsletter last week about levered ETFs. And one of the issues is they mimic the daily performance, meaning in the long term, these things can actually diverge from what the day, weekly, monthly, annual performance is. And so these vehicles are for trading. They are not for investing. You should not hold them after the close. They are not meant to be held, that is, after the close, because they operate on daily returns. And so if you're looking to get intraday short by 2 times real estate exposure that you will trade away, this is a vehicle for which you can do it, but that is a very specific use case. So for long-term investors, any levered ETF, even an inverse levered ETF, not the way to go. That is the ProShares Ultra Short Real Estate ETF, ticker SRS. Looks like we got a live call. Eric from Phoenix, you have a question about RSG. Do you own it or are you looking to buy it?
I own it right now. I know you guys had a caller call about it recently, but it's grown in my portfolio and it's my largest single stock holding, and it's about 9 to 10%. And I'm just wondering if I should hold on to it or try to trim, because my cash position is probably less than 1%.
Mm-hmm.
So I just wanted to get your opinion on that.
Yeah, of course. Well, Republic Services Group, it's ticker RSG, what they do is they remove non-hazardous solid waste. They transfer it, they dispose it, they recycle it, and sometimes they sell it for energy purposes. Their first quarter earnings, pretty solid, about $1.58, $1.58 per share versus an estimate of $1.53. Even though their revenue fell a little bit below expectations there, they've had a really solid year, up 25.36%. I think the rest of us all know where the rest of the market has been. But none of that really matters. It doesn't matter that they have good growth. It doesn't matter that their margins are stellar. It doesn't matter. Well, it does matter a little bit how expensive they are. They're actually trading the highest they have been over the past 5 years. What matters to me is it's almost 10% of your portfolio. You have certainly had it grow, which is congratulations, very successful investment on your side. But now it becomes a risk story. And it becomes a risk story for a company that is decently big, $79 billion, but I wouldn't say massively big, meaning that volatility works both ways. And so right now, even though it's performed very well compared to its industry, and really the S&P 500 going on 5 years now, it, I think, would be wise for you to start to trim it, not necessarily get rid of all of it, but keep in mind, it has not been more expensive than this, or barely has been more expensive than this over the past 5 years. So for RSG, looks expensive to me. Either way, big position, start to trim it. I would look elsewhere. Thanks for the call. We're going to fast forward a little bit because we don't have that much time before this next break. So we're going to talk about the last story that I mentioned, which is about how companies are talking about tariffs. Now, obviously, we've talked about them a lot. It is the dominant story so far this year. But as retail earnings have been more underway, we're starting to get more evidence that companies are taking this seriously. Now, a couple weeks ago, maybe last week, you had Walmart saying that they will start to raise prices on consumers. A little bit of backlash from the White House on that one. Target, Lowe's, TJ Maxx reported results. Home Depot reiterated its 2025 guidance, something that is a little bit rare, I would say, in this cohort, and also said it won't pass tariffs on to consumers. But I think, and I actually saw an interesting chart here, which took a look at, and I love these all the time. These are some of my best data points to look at. It's what people believe versus what is real. And in this case, it was what do people think margins are of companies versus what is real. And they looked at the average margin, and the average person thought that the margin of companies generally were 40%. They thought retailer margins, that is, your Walmarts, your Targets, they thought that was like north of 25, which we know, and we say all the time, and we just showed one earlier, Dollar General, who's on the high end of these retail names. They don't operate on big margins. If their costs are going up by 10, 15%, most of them have to pass this along. And that's just big companies. We're not talking about the mom and pop shops here. Over 400 S&P 500 companies have now mentioned tariffs in their Q1 earnings. Within the broader S&P 1500, 40 companies have discussed supplier negotiations or cost sharing between their suppliers and themselves. Under Armour, Skechers are just a couple of the names that have asked suppliers to absorb part of the increased costs rather than passing them on to consumers. Morgan Stanley has a language model analysis, and it found that supplier cost sharing is the fastest growing mitigation strategy for tariff impacts. And what they do is they look at earnings, see what they're saying, see what they're trying to do, and that's what it's determined. Still, though, the most common strategy is supply chain diversification. The problem with that being, okay, well, reciprocal tariffs across the world, how do you plan for that? Home Depot's plan is exactly that. Diversify your suppliers. Now, you saw Apple saying that they were going to start producing more iPhones in India. Some people took that to mean that they're going to move production to India. That's not what they were saying. They're essentially saying they're going to produce the ones they sell in the US and India in factories that already exist. But that's the thing here. We are mentioning stories because companies are taking it seriously. Oftentimes, I remember we actually had someone call in one time and let's say debate me about if CPI was real, if the inflation numbers were real. And my answer is, and always has been, Don't believe what the government is saying. Don't believe what I'm saying. Believe what businesses are saying. Believe what the businesses are saying. Inflationary pressures from tariffs may have softened, but certainly they're on top of minds of the US business leaders. From time to time, we receive InvestTalk questions and via web forms from investtalk.com, and here's one that came in earlier. It says, "Hello, longtime listener. Heard a question a few days ago on your podcast in regards to education plans. I have a guarantee education tuition plan in Washington State that my parents made soon after I was born, 1995. The plan is soon to roll over and become income for myself in 2029. You mentioned rolling it into a Roth. How would I go about doing that since I'm in the process of achieving a bachelor in social work in 2028? And so we have mentioned this before. This is a relatively new thing where you are potentially eligible to roll your unused funds from a 529 plan into a Roth IRA. Now, there are some rules here, right? To be eligible, your 529 has to be open for at least 15 years. In your case, my quick math tells me that it has. The funds also must be in an account where your name is the beneficiary. Lastly, any contributions made in the past 5 years cannot be rolled over. And so the steps you want to take is confirm you're the 529 beneficiary, ensure you have earned income in the rollover year, and coordinate with the plan administrator to process a direct rollover to a Roth IRA in your name. It can be a complicated process. If your parents or if you have a tax person or a financial advisor, I certainly recommend consulting with them because, again, it can be a little bit complicated. Thanks for submitting that web form. Now, there was some news today that the GOP lawmakers are aiming to dissolve PCAOB and roll its functions into the SEC. Now, the PCAOB was an entity that was created to restore confidence after the corporate auditing scandal from Enron and WorldCom. Now, opponents argue that the SEC lacks the capacity, they lack the funding, they lack the specialty, and the infrastructure to really do what the PCAOB has historically done since the early 2000s. Key votes opposing the plan, the MIT accounting experts, foreign regulators, former members of the board. Certainly you'd expect the members of a board emeritus members of the board to be against the dissolution of that board. But certainly, it can be a worrying sign for investors. If it is abolished, it would be critical that the SEC chair rebuilds the inspection capabilities, renegotiates dozens of foreign access agreements, including one with China, who right now we don't necessarily have a good, but maybe an improving relationship with. One of the reasons why I think they want to change this is because the PCAOB was primarily funded by public companies, broker-dealers. If they do cut this, the CBO estimates about $3.2 billion in savings. Sounds like a lot from government perspective. Drop in the bucket. We already talked about earlier how we are paying about $1 trillion a year in interest. I think that this comes down to a potential danger here, right? Regulatory capture. You have companies that want more of a say in their auditing regulation moving forward. Groups like the U.S. Chamber of Commerce, individual businesses suggesting that it may be a good idea to consolidate. And I'm not always against consolidation. Sometimes there is a regulatory burden here. But hope to understand some of the potential risks of reducing regulatory burden here. Because if there are concerns about the legitimacy of audits of companies, then markets that function on information being accurate stand to suffer. I'm Luke Herrera, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. While you're over there, we'd really appreciate it if you'd give us a rate and review. Now, if today's show made you think about yourself, about your financial picture, your investments, your taxes, your retirement, your kids' college savings, and whether all of it's really working together, set up a meeting. At KPP, we offer no-cost portfolio reviews to help bring a little bit of clarity, a little bit of confidence. If you're interested, Justin and I talk to listeners just like you every single day. Go over to investtalk.com and click the portfolio review button. We look forward to chatting. Independent thinking, shared success. This is InvestTalk. Good night.